Hello and welcome to Asset Zenith, your go-to source for smart financial guidance and investment insights. If you're new to the world of investing, especially when it comes to stocks, you're in exactly the right place. Today, we'll break down what a stock really is, how it works, and how you can start investing, even if you're a complete beginner. Let's dive in. Have you ever dreamed of owning a part of a company like Apple, Google, or Tesla? Not just using their products, but actually owning a piece of their success. That's exactly what happens when you invest in stocks. A stock, also called a share or equity, is essentially a slice of ownership in a company. When you buy a stock, you own a small piece of that business. As that business grows, your share can become more valuable. That's how wealth is built in the stock market. But why do companies sell pieces of themselves to the public in the first place? Companies issue stocks to raise money. Instead of borrowing from a bank, they raise capital by selling shares to investors. That money is then used to expand operations, launch new products, or pay off debt. In return, shareholders, like you, get to enjoy potential profits through rising stock prices or dividends. When you own stock in a company, you become what's called a shareholder. That means you have a financial stake in the company's future. If the business performs well, your investment could grow. If it struggles, your investment could lose value. But either way, you're connected to the company's journey. There are two main types of stocks you might hear about: common stock and preferred stock. Common stock is the most popular and widely held. It gives you voting rights in the company and the possibility of receiving dividends, which are portions of the company's profits paid out to shareholders. These dividends aren't guaranteed, but many successful companies pay them regularly. Preferred stock is a bit different. It usually comes with fixed dividends, meaning you know how much you'll receive and when. Preferred shareholders are also paid before common shareholders if a company runs into financial trouble. However, preferred stock typically doesn't come with voting rights. Most beginner investors start with common stock, and that's what we'll focus on today. So, where does all this buying and selling actually happen? The answer? The stock market. The stock market is a place where investors trade stocks, buying and selling ownership in companies. Some of the most well-known stock markets include the New York Stock Exchange, the Nasdaq, and the London Stock Exchange. Think of it like an auction, where buyers and sellers set prices based on supply and demand. When more people want to buy a stock, the price goes up. When more people want to sell it, the price goes down. But what causes people to buy or sell in the first place? There are many factors: company performance, news events, market trends, economic data, and even emotions. A company that reports strong earnings may see its stock price rise. But if investors get nervous about the economy or global events, prices can drop quickly. It's important to know that stock prices are always changing. They move up and down, sometimes dramatically, and that's perfectly normal. So how do you actually make money from investing in stocks? There are two main ways. First, capital gains. That's when the price of a stock goes up and you sell it for a profit. For example, if you buy a stock at $50 and sell it at $80, you make $30 per share. Second, dividends. These are payments made by companies to their shareholders, usually every quarter. Dividends are a way for companies to share profits with investors. Not all companies pay dividends, but those that do can provide a steady stream of income. Many long-term investors use a mix of capital gains and dividends to grow their wealth steadily over time. Now, let's talk about how you can start investing in stocks, step by step. Step 1. Set your financial goals. Why are you investing? Are you saving for retirement, building a college fund, or just trying to grow your wealth? Knowing your goals helps you choose the right investment strategy. Step 2. Make a budget. Only invest money you won't need in the short term. Make sure you have an emergency fund in place first. Then decide how much money you can afford to invest each month or year. Step 3. Open a brokerage account. This is the platform where you'll actually buy and sell stocks. Look for a broker that's easy to use, has low fees, and offers solid customer support. Some popular brokers include Fidelity, Charles Schwab, Vanguard, and online platforms like Robinhood. Step 4. Do your research. Before you invest in any stock, take time to learn about the company. Look at their financial reports, their products or services, their competitors, and their leadership. Try to understand what gives them an advantage and whether they're likely to grow. Step 5. Diversify your investments. Don't put all your money into a single stock. Spread it out across different industries or consider buying exchange-traded funds, also known as ETFs. These give you access to a collection of stocks in one package, which helps reduce risk. Now let's be honest, investing isn't without risk. The value of your investments can go up, but it can also go down. Markets can swing because of economic shifts, company news, global conflicts, or even investor fear. But here's the key. Don't panic. Successful investors understand that the market goes through cycles. Prices might fall for a while, but over time, the stock market has consistently risen. That's why long-term thinking is so powerful. Avoid checking your portfolio every day. Don't make emotional decisions based on short-term news. And never invest money you can't afford to leave alone for at least a few years. Here are a few simple tips to help you get started the right way. Start small, but start now. You don't need thousands of dollars. Even a small, consistent investment can grow significantly over time. Invest regularly. Try using a strategy called dollar cost averaging, where you invest a set amount each month, regardless of the stock price. This smooths out market ups and downs. Think long-term. The longer you hold good investments, the more time they have to grow. Don't try to time the market. Even professional investors struggle to predict short-term movements. Focus on long-term value instead. Keep learning. Read books, watch reliable videos, follow financial experts. The more you know, the better your decisions will be. Now, take a moment and reflect. Have you started investing yet? If not, what's been holding you back? Is it fear, confusion, or just not knowing where to begin? Or maybe you've already taken that first step. If so, what was the first stock you ever bought? What did you learn from that experience? Every investor's journey is different, and there's no shame in starting small or making a few mistakes along the way. What matters most is that you stay curious and committed to your financial goals. Your story might even inspire someone else who's just starting out. So, take a moment to share your thoughts and experiences. We're all learning and growing together. To wrap it all up, investing in stocks can be one of the most effective ways to build wealth over time. It gives you the opportunity to own a piece of real businesses, benefit from their success, and grow your money beyond what savings accounts can offer. It may seem complicated at first, but once you understand the basics, what a stock is, how the market works, how to manage risk, the process becomes much more approachable. You don't need a degree in finance to be a successful investor. What you need is curiosity, discipline, and the courage to begin. You've already taken the first step by listening to this guide. Keep learning, stay patient, and your future self will thank you. Thank you for being here with Asset Zenith. If you enjoyed this episode, don't forget to follow our channel so you never miss helpful insights on building wealth and financial freedom. Until next time, keep learning, keep investing, and keep growing. Your financial journey is just beginning.